In this presentation, we will work a problem related to recording transactions in the debt service fund for term bonds and the activity for them. We have the information on the left side. We're going to put that information into the blue area on the right side, including journalizing the journal entries and then posting them to a worksheet. That worksheet including a trial balance, chart of accounts, beginning balance, adjustments, and ending balance to get an idea of the accounts that will be increasing and decreasing as we go. We have the assets in green, liabilities in orange, what would be equivalent to the equity section, assets minus liabilities, or fund balance, light blue, dark blue being those income statement or what would be income statement type of items for a for-profit organization. Here, those temporary accounts, those accounts we would expect to be closed out to the light blue or the what would be equity type of accounts. Let's go to the left and see the information we have. We're going to say that we're issuing bonds for a capital project. That's just going to be the amount. Then we have the rate, 4%, mature in 5 years. They're going to be paid interest semi-annual. Okay, so first we're going to start off with the budgetary information. We're going to estimate based on this information that we're going to have revenue because we're going to be investing some of these items of the $9,000, and we have estimated transfer from the general fund of the $1,024,204. In other words, we believe that we've estimated that we're going to need from the general fund. The general fund's going to be financing, transferring in that $1,024,204 in order to cover the debt service fund activities. So we need to first consider our estimates on the left. So our estimating type of accounts are going to be down here. We got the estimated revenues. We need to have estimated revenues, estimated other financing sources we're going to have, and then the appropriations is the estimate related to the expenditures. So we'll start off with the estimated other financing sources. That's going to be kind of like an income statement account. Remember that income statement accounts have credit balances. Therefore, the budgetary account will have a debit balance. So we will put this on the books at a debit balance, estimated other financing source, and that's going to be equal to, we're estimating that to be this $1,024,204. So that's going to be the other financing source. And then we're going to have estimated revenue because we're going to take this information and invest it, and we expect to have revenue on that. That'll be equal to, and we're looking for the estimated revenues. We'll pick up the estimated revenue. And that amount will be we're estimating we're going to have income from our investments of the $9,000. So $9,000. Then we're going to have the other side, which is going to be similar to the expenditures, the estimated expenditures, which we're going to call appropriations. The appropriations, expenditures have a debit balance. Therefore, the appropriations will have the opposite or a credit balance. So we'll pick up the appropriations and we're going to estimate that amount. We'll do that with a quick calculation here. I'm going to say it's going to be a credit. So I'm going to say negative, pick up the face amount times the 4%. And then I'm going to divide that by 2, saying we're going to have one payment. So that's going to be the $92,000. So that's our estimated appropriations or expenditures. Then we need the negative sum for the balance, difference. And that's going to be this amount. And that's, of course, going to go to the budgetary fund balance. That's where our difference is going to be. Let's go ahead and record this out then. We're going to say that the estimated other financing sources are going to be down here. We're going to say the estimated other financing sources in L10 will be equal to, scrolling back up, picking up that $1,024,204. Then we have the estimated revenues. So estimated revenues in cell L9 equals, and we'll pick up that debit of $9,000. Then we have the appropriations. So the appropriations are going to be right in L12 equals, and we'll pick up the credit in appropriations. And then finally we have the fund balance. So the fund balance, and so that's going to be the budgetary fund balance in L7. L7. And so there we have that. So now we've posted the budget. That puts us back in balance. See the next item that we have. Number 2 then says the general fund transfers to the debt service fund. So we're going to transfer from the general fund to the debt service fund. We're going to be concentrating on the debt service fund. So this money is coming from the general fund into the debt service. In the debt service then, we're going to have an increase in cash or a debit to cash. And the other side is going to be kind of like revenue, but it's going to act like revenue, but it's going to be an other source. So we're going to say the other side is going to be a credit. It's going to be the other financing source, interfund transfer in. And so we're going to say that amount, the amount that was transferred in is going to be this amount, 512,102 for the debit and the credit. Let's post that. So here's going to be the cash up top. We're going to go into L3 and say equals and scroll down to the cash amount. So that increases the cash. And then we've got the other financing sources. So the other financing sources is in L11 equals, and we'll pick up that item, increasing that amount. Okay, so let's take a look at the next transaction. We then say that we had made an investment. So we took this money and we made an investment with it. So we're going to invest it on a short-term investment, gaining some interest on it until we use it to finance the debt. So we're going to invest it, investing this amount into something you could think of like stocks and bonds or something like that. So then we're going to say we make an investment. That's going to be an asset. Now, it's going to be a short-term asset typically, and that's why we're going to be recording it here in the debt service fund, which is typically on a modified accrual basis. And then the other side is going to be going to cash. So there we have that. And this is going to be for the amount of the 421.02. That'll be the debit and the credit. So let's record that. We got the investments starting off. So if we go up top to the investments, we are in L4 equals, and we'll scroll down and pick up the investment of the 421.02. And then we're going to pick up the cash right above it. So cash is right above it. Something's in it. I'm going to say F2 plus F2. Scroll back down and pick up that cash, which is the credit. And that'll put us back in balance here. Okay, let's see the next transaction. We are now on, it looks like number 3. So we're on number 3. We also might want to highlight the ones above it as we go. So I'll make them green. So we've completed the green ones. Number 3 says we're going to pay the interest on the bonds. So now we're going to pay the interest on the bonds. We're going to pay them with cash. So we know that cash is going to be going down. That's fairly straightforward. Nothing too unusual there. The top of the item is going to be an expense, and we're going to record it to the interest expense because we're paying off the bonds, and that'll be the interest on the bonds. Let's do a quick calculation of the interest. We're in cell G14. It's going to be equal to, I'm going to scroll up to the face amount of the bond times the 4%. That would be for a year. Taking that and then divide it by 2. So the face amount times 4% divided by 2, 92,000, because it's a semi-yearly bond. And there we have it. And so that's going to be our transaction. Let's record that then. We're going to say the expenditures are here. And that's in L13, so that equals, and we'll pick up the 92,000. And then the cash will be up top. So we'll be up top in cash. We're in L3, F2 plus F2, and we'll pick up the cash. So cash going down. There we have that one. Back in balance with the green zeros. Let's see what we have next. I'll go ahead and make this green. So we've completed that. That is now green. Number 4 then says we have a transfer from the general fund to the debt service fund. So now we've got another transfer. It's going to be a standardized process. As we go through this, we've planned this out. We've got the transfer that's going to be coming in, and then we're going to make the investment with it until we need the cash to pay for the financing of the bonds. So once again, we got the cash coming in, and we're going to say cash is increasing because we're in the debt service fund, and it's coming from the general fund. So we're going to say cash goes up for us here in the debt service fund. We're here at this point in the debt service fund, and then it's coming from the general fund, which is going to be kind of like an income account, but it's going to be this other financing sources account, interfund transfer in. And then the amount is going to be for that 512,102. That'll be the debit and the credit. So let's record this now. We've got the cash first. So we'll scroll up to the cash up top. We're in L3. I'm going to say F2 plus F2. Scroll back down and pick up that increase in the cash. Then we've got the other financing sources, transfer in. So we have the other financing sources. We are in L11. F2 plus F2. Scrolling back down, we'll pick up that 512,102. And there we have that. So we're back in balance there. And then we turned around and we took that money and we are going to put it into a short-term investment. Again, short-term, modified accrual. It's going to be kind of like a current asset. Therefore, that's why we're putting it on the modified accrual statement here, because we're just putting it there until we actually pay the interest to get a little earnings on it. So we're going to say this is going to be equal to the investment. And then cash is going to be the other side. We're going to turn around and take that cash and invest it for the amount of 420,102. So there is our investment. Let's post that out. Scrolling up top, we're going to pick up the investment in L4. I'm going to say F2 plus F2. Scroll back down and we'll pick up that investment. And then the next one, we have cash underneath that. So I'm going to go back up top. We'll pick up the cash in L3. F2 plus F2. Scrolling back down. And we'll pick up the credit to cash there. And that puts us back in balance. So there is that one. Let's take a look at number 5. We're going to go ahead and make this green, indicating that it has been completed. Number 5 says that there's interest earned on our investment of the $9,000. So this money we've been putting into the investments earned $9,000, which happens to be exactly what we estimated it to earn, which is nice. So we're going to say, okay, so the investment is earning, and it could be, if we're, depends on what we're investing. If it's some kind of annuity, that could quite well be the case. So we're going to say investments are going to go up, increasing the investments. And we're going to say that the revenue is the other side. So investment earnings, we're going to have some type of earnings. This is going to be revenue rather than our other sources, which are typically other financing sources that transfer in. Revenue from the investment, and that's going to be for the amount that we earned. And we earned $9,000. There's the debit and the credit. So we're going to say investments $9,000. So let's scroll back up. And investments are going to be increasing $9,000. I'm going to say F2 plus F2. Scrolling back down, investments went up by $9,000. And the other side, we're going to put to revenue. So we're in L8. This equals, and that's going to be increasing on the credit side. So revenue goes up. All right, let's see what else we have. We're going to say the next item is number 6, and we're going to close this thing out. We're going to close everything out now. In other words, it's the end of the time period, and we need to close everything out. So if I scroll back over, we need to make all these accounts, in essence, 0. All the temporary accounts, we need to make 0. Now, the confusing thing here, of course, is that we have budgetary accounts, and we have the non-budgetary type of temporary accounts that we need to close out. So that's what we need to kind of break out. We typically think of the closing process in 2 separate transactions. Then we're going to close the budget out, and then we'll close like the normal type of what we would think of as temporary accounts in relation to a for-profit organization. So let's first mark those off. The estimate accounts, this is a budgetary account. Anything that says estimate, budgetary account, budgetary account. This is appropriations is budgetary. And we're going to close that out to the equity account, which is the budgetary equity type account if it was a for-profit, or the fund balance type of account, the budgetary fund balance type of account. And so there we have that. So let's close those out first. So we'll go to the revenue. Revenue has a, the estimated revenue has a debit balance. Therefore, we're going to do the opposite thing to it and credit it. And I'm going to build this up just basically as it goes in order. And so you could then rebuild it, put the debits on top and the credits on the bottom if you so choose. It might be easier in practice not to, if you don't have to, because then you could see how you made the journal entry, which I would recommend doing because that's an easier audit trail for you to go back and look at. We could say, I built, this is how I built it. I can see how I constructed this thing instead of formatting it in a random debits on top type of order, which doesn't tell you anything. So we're going to say that there's that, and the amount that's in there is, of course, that 9,000. So we'll say that's 9,000. So I'm going to credit the 9,000. And then next we have the estimated other financing sources, also a debit. So we're going to credit it. So I'm going to pick up the other financing sources, and it's got a debit of $1,024,204. So we're going to credit it by that same amount, negative $1,024,204. So there is that. Next budgetary account we have is the appropriations. It's got a credit in it because it's the opposite of an expenditure, and so we're going to remove it. So we'll scroll back down and say we want appropriations is going to be the next one. This is going to be equal to the appropriations, and it's got 92 that we need to debit to make it go down. doing the opposite thing to it, 92,000. And then what we need for the budgetary fund balance is going to be a debit to make this thing go away. That's going to be the negative sum plug formula, debits minus the credits. And that's going to go into the budgetary fund balance. Budgetary fund balance is this one. And note that of course, is exactly what's in there at this time. So note that this journal entry, you can also think of it as the exact opposite of the budgeting journal entry when we first put it in. Unless there's some kind of estimate to the budget, then it's going to be the exact same as the budgetary journal entry we started with. Let's record it now. So we're going to go to estimated revenue up top. So estimated revenue is here, and we're going to say F2 plus F2. Scroll down to that 9,000. That should make it go away, go to 0. Then we have the estimated other financing sources. So estimated other financing sources, right below it, we're in cell L10. I'm going to say F2 plus F2. Scroll back down, and we're going to pick up that credit balance and enter. And that should make it go down to 0. Then we have the appropriations. So here's the appropriations. If we scroll back up, here's the appropriations. We are in cell L12. Say F2 plus F2. Scroll back down and pick up that debit for the appropriations. And then finally, we have the budgetary fund balance. So we can see the appropriations went down to 0. Budgetary fund balance in L7. I'm going to say F2 plus F2. Scroll back down and we will pick up the budgetary fund balance. And then it goes down to 0. So we've cleared those out. Then we just have the activity, which is the actual activity, right? We've got the actual revenue, the actual kind of other type of revenue similar to revenue transfer in, and then the actual expenditure that we need to close out. We're going to close out then to the actual fund balance rather than the budgetary fund balance. So to do that, we're going to start off with the revenues. Now it has a credit balance here, so we're going to do the opposite thing to it, which is going to be debit the revenue. So we'll scroll back down. I'm going to make another journal entry. We're going to start it off just going from top to bottom once again. And we'll just go to top to bottom. There's the revenue. It's got a credit in it, so we're going to debit it 9,000. Then the next thing that's still hanging around here is going to be the other financing sources, and we want it to go away, so we're going to do the opposite thing to it. There's a credit. We're going to debit it. So we're going to say, hey, this is going to be equal to the other financing sources, and we're going to debit it for the 1024204. So that should make it go away. And then we have the expenditures for the interest. That's going to be the last one. It's got a debit in it, like a normal expense would. And now, so we're going to credit it to make it go away. So we're going to say we need to credit it because we're closing it out to where we want it to go, which is the fund balance, of course. And that's going to be for a credit of the credit of the 92,000 was in there, I believe, I hope. And so the difference then, debits minus the credits, negative sum, is going to be the 941,204. And you might say, hey, this matches out really nicely. Why? Because this is a type of bonds that we were able to plan perfectly, because we've already mapped this thing out in terms of the exact financing that's going to need for the bond. So we put it on the books in terms of what the budget will be, everything planned out exactly like it should. And now we're going to reverse it, and that's because the types of bonds we're using, of course, are going to be very standardized. The investments we put in are very standardized, and therefore we were able to have an exact budget of what's going to happen as compared to what did happen. So then this is going to go to the budgetary fund balance. This will be the budgetary fund balance. There we have it. This amount should actually be the fund balance, not the budgetary fund balance. We'll fix that in a little bit here. Let's post it now. So we got the revenues. So if we scroll back up and we say we have the actual revenues in L8, something's in it. So I'm going to say F2 plus F2. Scroll back down and we'll pick up the revenue, 9,000. Then we've got the other financing sources. So we're going to have that down here in cell L11. So I'm going to say F2 plus F2. Scroll back down. We want the other financing sources and enter. Then we've got the expenditures. So expenditures, if we scroll back up, want to pick up the expenditures. That's in L13. F2 plus F2. Scrolling back down, and we'll pick up the expenditures, and then finally the fund balance. So here's the budgetary, I'm sorry, this shouldn't be the budgetary fund balance. This should be the actual fund balance. This should be equal to the fund balance here. And then that's going to be equal to that 91,204, enter. And so there we have that. So now we've closed everything out. We've got both the budgetary accounts closed and the normal accounts closed, and the budgetary fund balance has now been reversed exactly. And we have the fund balance here, and of course the assets minus liabilities, if we had any, add up to the budgetary, or not the budgetary, just the fund balance.